The charts you are looking at today are red. There is panic in the air. People are asking if this is the bottom. They're drawing lines on graphs talking about support levels at 40,000 or 30,000. But they are missing the point. They are treating this like a normal market cycle. Like a correction. But what if it isn't? What if the red candles we see today are just the tremors before the earthquake? We have built a trillion-dollar skyscraper on a foundation of wet sand, and the tide is coming in. Today, we are going to run a simulation. We're going to walk through a scenario that few people want to talk about, but every serious investor needs to understand. We are going to simulate the liquidity trap. The day the music stops and there are no chairs left. This is not a prediction of doom. It is a stress test for your conviction. Imagine it is November 2026. The crypto market has been bleeding for 6 months. The hype of the last cycle is a distant memory. The tourists have left. Only the believers and the over-leveraged remain. It begins on a Tuesday morning, not with a bang, but with a press release. A major regulatory body, let's call them the Global Financial Oversight Committee, releases a coordinated report with the U.S. Treasury. The headline is dry, bureaucratic. Enforcement action regarding non-compliant stablecoin issuers. For years, the market relied on stablecoins, digital dollars like Tether or USDC, to provide liquidity. They are the poker chips of the casino. We trust that one digital dollar equals one real dollar in a bank account somewhere. That trust is the only thing holding the system together. The report alleges that the largest stablecoin issuer in the world holds less than 40% of their reserves in actual cash. The rest? It's in commercial paper, junk bonds, and Bitcoin itself. They are insolvent. The market reacts instantly. On Binance, on Coinbase, on Kraken, the peg breaks. The stablecoin trades at 99 cents, then 98 cents. At first, the algorithms kick in. Arbitrage bots try to buy the dip, thinking it's free money. They push the price back to 99 cents. But the selling pressure is human, and it is relentless. Rumors start flying on the Twitter. They are freezing assets. The CEO has fled. Panic is a funny thing. It moves slowly, then all at once. By 2 p.m., the stablecoin is trading at 90 cents. This triggers the first catastrophe. The flight to safety paradox. Investors want to get out of the dying stablecoin, but they can't withdraw to their bank accounts because the banking rails have been suspended by the regulators. So, what do? They buy Bitcoin. Ironically, in the first few hours of the collapse, the price of Bitcoin skyrockets. It shoots up 10, 20% in minutes. The charts look green. It looks like a rally. But it's a mirage. People aren't buying Bitcoin because they want it. They're buying it because it's the only lifeboat on a sinking ship. They're trading a dying currency for a volatile asset. But then reality sets in. You have Bitcoin. Great. Now, how do you buy bread? How do you pay rent? You try to sell that Bitcoin for fiat currency, USD, Euro, Yen, and that is when you discover the door is welded shut. The exchanges, overwhelmed by the flood of withdrawal requests, halt operations. Technical difficulties, the screen says. Wallet maintenance. We've seen this before with FTX, with Celsius, but this time it's everywhere. The liquidity, the real dollars, isn't there. The price of Bitcoin on the screen is meaningless if you cannot sell it. The price might say $50,000, but the real liquidity is zero. Now, we enter phase 2, the DeFi cascade. Desperate for cash, whales start dumping their positions on decentralized exchanges, DEXs, like Uniswap. But remember, the stablecoins used in these liquidity pools are now worthless. The automated market makers break. Lending protocols like Aave and Compound begin a mass liquidation event. Billions of dollars in loans are called in instantly. But because the liquidity has evaporated, the collateral is sold into a void. It pushes the price of Ethereum and Bitcoin down vertically. We are no longer looking at a correction. We are looking at a flash crash. Bitcoin drops from $50,000 to $20,000 in a matter of hours. This brings us to the most dangerous part of the simulation, a concept known as the miner death spiral. Bitcoin is secured by energy. Miners spend billions on hardware and electricity to process transactions. They do this because they profit from the block reward. But they have bills to pay. They have debt. Most industrial miners have a break-even price. Let's assume in 2026 that price is around $25,000. If Bitcoin falls below that level, they're mining at a loss. Usually, they have cash reserves to survive a bear market. But in this liquidity crisis, their reserves are frozen or devalued. One by one, the mining farms in Texas, in Kazakhstan, in Latin America go dark. They pull the plug. The global hash rate, the computing power securing the network, plummets. Now, here's a technical nuance that few people discuss. Bitcoin has a difficulty adjustment mechanism. It recalibrates how hard it is to mine a block every 2016 blocks, roughly every 2 weeks. If the hash rate drops by 50% overnight, the network doesn't adjust immediately. It stays difficult. This means blocks that usually take 10 minutes to solve now take 20 minutes, then 40 minutes. The network slows to a crawl. Transactions stop clearing. You try to move your Bitcoin to a cold wallet to save it. It gets stuck in the mempool. You are trapped. Fear turns to anger. The mainstream media picks up the story. The end of crypto. The great digital Ponzi scheme collapses. Politicians take victory laps. They launch Operation Chokepoint 2.0, effectively banning banks from interacting with any crypto-related entity. By day 3, Bitcoin is trading at $8,000. The vast majority of altcoins, the projects with marketing teams, CEOs, and roadmaps, go to zero. They simply cease to exist. Their treasuries were held in the failed stablecoins or their own tokens. They cannot pay their developers. GitHub repositories go silent. The Discord servers turn into ghost towns. This is the great filter. 99% of the cryptocurrency market evaporates. The NFTs, the metaverse lands, the governance tokens, gone. Trillions of dollars of paper wealth deleted. And for the retail investor, the person who put their life savings in because they watched a Super Bowl ad or listened to an influencer. It is a tragedy. Marriages end, homes are lost. The psychological toll is immeasurable. The anger is directed not just at the scammers, but at the technology itself. Bitcoin becomes a dirty word. To mention it in polite society is to admit you are a fool or a criminal. The winter sets in. And this isn't a winter that lasts 18 months. This is an ice age. It lasts for years. The price stabilizes, perhaps around $3,000 or $4,000. The level of hardcore support from people who simply will not sell no matter what. I want to pause the simulation for just a moment right here. Look at that hypothetical price tag, $3,000. The media is calling it a scam. Your friends are laughing at you. Be honest with yourself and answer this question in the comments below. In this scenario, do you buy more or do you sell everything and walk away? I want to see how many of you would actually have the stomach to survive this winter. Let me know. Now, back to the simulation. The exchanges that survived are unrecognizable. They are heavily regulated, essentially becoming traditional banks with a different database. KYC is mandatory for every single Satoshi. The era of the Wild West of anonymous freedom feels over. But is it really over? Let's look at the ashes. In the silence of this destruction, something remarkable happens. The speculators are gone. The scammers are in jail or hiding, the noise is gone. But the Bitcoin network, it is still running. Even with half the miners gone, the other half remains. Eventually, the difficulty adjustment kicks in. The blocks start flowing again every 10 minutes. Tick, tock, next block. The code didn't break. No one hacked Bitcoin. The CEO didn't run away with the money because there is no CEO. The protocol did exactly what it was designed to do: produce blocks, truth, and scarcity, regardless of the price, regardless of the politics. Slowly, a realization begins to form among the survivors. The collapse wasn't a failure of Bitcoin. It was a failure of the crypto industry. It was a failure of the centralized intermediaries, the banks, the exchanges, the stablecoin issuers, that tried to wrap Bitcoin in the old financial system. Bitcoin didn't need stablecoins. Bitcoin didn't need leverage. Bitcoin didn't need yield farming. The people who are left are the ones who understand this. They start rebuilding. But this time they build differently. They abandon the centralized exchanges. They build circular economies where goods and services are priced directly in Bitcoin. They stop caring about the exchange rate to the dollar because the dollar system has proven itself to be a weapon used against them. Technological innovation explodes. Without the distraction of token prices, developers focus on scaling, on privacy, on usability. Layer 2 solutions become seamless. 5 years after the crash, Bitcoin hasn't recovered its all-time high. It's not headline news, but it is being used. It is being used by dissidents in authoritarian regimes. It is being used to settle international trade between nations that don't trust each other's currency. It's being used as a neutral reserve asset by small energy producers. It has returned to its roots. It is no longer a get-rich-quick scheme. It is a don't-get-poor technology. So, why did we run this simulation? Why simulate the end of the world? Because if you are holding Bitcoin today, you need to ask yourself, what are you actually holding? Are you holding a lottery ticket that you hope to sell to a greater fool for more fiat currency? If so, the scenario I just described is your nightmare. If liquidity dries up, your ticket is worthless. Or are you holding a share in a new indestructible monetary network? If Bitcoin goes to zero in dollar terms, does it matter? One Bitcoin is still one Bitcoin. If the dollar system collapses, or if the bridge between crypto and fiat is burned, the value of Bitcoin doesn't disappear. It just decouples. We are currently living through a period of maximum greed and maximum fear. We are drunk on leverage. We are dependent on centralized stablecoins. We are vulnerable. Crash is not impossible. In fact, mathematically, a deleveraging event is inevitable. The question is not if it happens, but who survives it. The future belongs to those who can endure the volatility without losing their vision. It belongs to those who self-custody. It belongs to those who verify and don't trust. When you look at the red charts today, don't look at the price. Look at the hash rate. Look at the node count. Look at the code. The price is a distraction. The liquidity is an illusion. If you want to navigate these waters without drowning, if you want to understand the mechanics of money before the crisis hits, you need to be watching this channel. Hit that subscribe button and turn on notifications. Don't let the algorithm decide your financial future. Stay safe, stay humble, and keep stacking.